to Borak Bersama Maybank. We have a new episode today to wrap up the first quarter results for stocks under our coverage. Results this time around were in general a lot softer, with earnings for a few companies not meeting expectations. To help us unpack, we have Sue Lin, our head of equities research in Malaysia, to take us through the team's latest earnings roundup report. Welcome back to the show, Sue Lin.
Hi.
So Sue Lin, let's kick things off with the usual recap. Could you just give us some color on the overall performance of the stocks under our coverage?
Sure. So the first quarter's earnings were unfortunately quite uninspiring this time around. We've seen quite a fair bit of declines, both year on year and on a quarter-on-quarter basis. We've about close to 100 companies under our coverage, maybe a little more if you were to include the other financial year ends. But based on the ones that ended in February and March, about 28% of them delivered results that were below the team's expectations. Unfortunately, there were also no clear sectors that outperformed. The banks, which typically always perform, also came in below expectations, and similarly for the sector like gaming. While more than half the stock sectors covered in our universe were in line, the rest were relatively mixed, though with a negative bias. So with that said, our misses exceeded beats this time around versus even the last quarter.
All right. Thanks, Sue Lin. So with softer earnings for this first quarter, I guess you and the team clearly have made some revisions to your earnings estimates and our year KLCI target for 2025. Can we have that, please?
Sure. So we've downgraded about a third of our companies and upgraded about 12 companies following the results season. And the main downgrades came mainly from banks as we trimmed loan growth and margins while raising credit costs. This is in line with the overall softer macro outlook for the year, knowing what's happening around the world. The other sector that saw some earnings downgrades was the plantations, but it's a combination of both higher export levies as well as weaker downstream operations. We've also lowered some of the oil and gas sector earnings as well as the ratings, mainly because of the softer capex expectations going forward, given what's happening at Petronas. But on the bright side, we did see some upgrades, and this came in from consumer and the REITs counters. But all in all, mainly due to the downgrades, especially coming from the banking sector, we've trimmed our KLCI earnings growth estimates for the year. We're now looking at 2.5%, but looking at 2026, given that 2025 is a lower base, 2026 earnings is a little stronger at 7.7%. Now that said, our KLCI target for the year end is a little lower at 1660 versus 1700 before. We are pegging it to a lower price to earnings ratio of 14.4 times versus 15 times previously. And this is to reflect the market volatility as well as tariff uncertainties.
All right, thanks, Sue Lin. So just to recap a bit for our audience, the research team has downgraded the outlook of both the banking and oil and gas sectors, and have also lowered our year-end KLCI target to a modest 1660 as of going to be in the year-end of December 2025. So before we wrap this up, has there been any changes to our top buys list? And in general, what's the overall game plan for the rest of the year?
Sure. So for the strategy, we obviously started the year a bit positive, a lot more positive, but because of what's happening around the world, we're now a little bit more cautious. So our strategy remains very defensive and looking for yield plays amid market volatility. However, in addition to the 10 stocks that we recommended earlier this year, we're now adding 2 more. We're adding Tenaga and we're adding Sunway REIT into our list. For Tenaga, we see the eventual finalization of the recovery mechanism for the RP4 or regulatory period 4 as a potential catalyst for the stock to outperform. And meanwhile, for Sunway REIT, we are robust about its retail performance and also strong growth expectations from its recent acquisitions as well as asset enhancing initiatives. There are no other changes to our top picks. We continue to like our consumer sector, healthcare, renewable energy, as well as REITs and construction.
All right, that's a wrap for today. Aside to the audience, you can catch our latest research report on your Maybank Trade MY app. All you need to do is just head over to the Insights tab and you will be able to find it there. And for those who are looking to trade stocks, structured warrants or futures, you can apply for a CDS or trading account online via the QR code on the screen now. But if you need a personal touch, you can also approach our sales representatives and they can help get you started with a trading account. With that, we'll catch everyone in the next episode. But until then, this is Najib Hussain signing off.